Welcome back to the Neuro Finance Masterclass. Today, on day 118, we look at the literal human foundation of the blockchain network.
Exactly. Yesterday, on day 117, we nailed down corporate growth velocity with the PEG ratio. But today we're heading straight back to the on-chain digital frontier. We're getting highly quantitative to measure the absolute most fundamental engine of any decentralized network out there, its users. We're talking the real network effect here.
Here's our high-stakes syllabus for today. We're going to shatter the network illusion, break down active versus new addresses, and unpack Metcalfe's law. Then, we'll use all that to filter out bearish divergences before we wrap up with a strict adoption audit. We are ruthlessly, and I mean ruthlessly, shifting our focus from pure speculative hype to actual mathematical network scaling. All right, let's jump right into section 1, the network illusion. Amateurs get completely blinded by slick marketing, flashy websites, or just rapid, crazy price pumps. But honestly, that is a super dangerous illusion. To really grasp valuation in this space, we have to look past the surface and dig into the quantitative reality. There's a rule we live by here. The architect ignores the noise. Think about it. Fundamentally, a blockchain is just a communications network, right? If literally nobody is opening wallets or sending transactions, it's just a ghost town. It's just waiting to deflate. It doesn't matter one bit how artificially high the price is being pumped. If there's no human foundation, it holds absolutely zero structural weight. None. Which brings us to section 2, active versus new addresses. To actually embed this quantitative reality into your neurofitness, you've got to track these two vital signs. They literally tell you if a network has a pulse. So we really need to understand the stark difference between ongoing utility and fresh inflow. First up, active addresses, or aktif adresler in Turkish. This is the total number of unique wallets participating in a transaction, either sending or receiving, within a specific 24-hour window. This is your measure for real ongoing utility.
Right. And on the flip side, we've got new addresses, or yeni adresler. These are unique wallets showing up on the ledger for the absolute first time. This tracks the fresh, or taza, network inflow and user onboarding speed. And you absolutely need both of these metrics to gauge true structural health.
So how do you spot when the data is flat out lying to you? Picture this. A blockchain is parading around massive transaction volumes, but its active addresses, they're totally flat or even shrinking. What's actually happening there? Wash trading, pure and simple. It's just a few insider whale bots ping-ponging the exact same tokens back and forth to fake demand, which is exactly the trap we exposed back on day 92. True, organic economic expansion demands a steady, compounding crawl of unique human nodes. High volume with zero user growth, that's just smoke and mirrors, guys. Okay, moving into section 3, Metcalfe's law explained. If real human nodes are the lifeblood, we need to mathematically quantify exactly how much they matter. Time for a tactical briefing. Have you heard of Metcalfe's law? It was originally cooked up for telecommunications, and it states that the systemic value of a network is proportional to the square of the number of its connected users. This isn't some abstract theory, by the way. This math is exactly why decentralized networks capture such mind-blowing structural valuations. The formula itself is V is proportional to N squared. Simple, but honestly, devastatingly powerful. See, network value doesn't just scale up on a straight, boring line. It scales exponentially. This nonlinear explosive scaling factor, it is the secret engine of wealth creation in the whole digital asset space. Let's put some actual numbers to this to see the math in action. If a network has 10 connected users, its network value factor is 10 squared, so 100. But if you double those users to 20, the value factor doesn't just double to 200. No, it explodes to 400. Just by doubling the users, you've completely quadrupled the structural value. Seriously? Think about what this means for behemoths like Bitcoin, Ethereum, and Solana. Their gargantuan valuations are built entirely on this exact nonlinear scaling. Every single new user that joins the ledger doesn't just add a tiny bit of linear value. They mathematically expand the utility of every other existing user. It's like a telephone. One phone is a paperweight. 2 is a connection. Millions, that's an indispensable global infrastructure. All right, let's pivot to section 4, the bearish divergence filter. An architect doesn't just use these metrics to find value, right? We use them as an early warning shield against nasty macro trend reversals. Let's contrast a late-stage bull market with a deflating on-chain reality. During those late-stage overexpansions, like we talked about on day 115, you get this speculative veneer. Prices are just blasting upward to new highs, totally fueled by leverage and blind momentum.
But here's the catch. If you look at the human foundation, the active and new addresses, and you see them aggressively dropping while the price is sky high, boom, you've got a massive bearish divergence. The price is literally lying to you.
When you spot that divergence, you need to execute a strict action plan immediately. Step 1, recognize that the human foundation is actively deflating. It's shrinking.
Step 2, acknowledge that the upward price trend is fundamentally empty. It is a speculative veneer running on borrowed time.
And step 3, trigger your defensive capital preservation shields instantly. Remember day 102? Protect your capital. Do not wait for the market to correct, because a network with disappearing users doesn't just correct, it collapses. Okay, section 5, the adoption audit. Let's get into today's strict, actionable cognitive task. Grab your notes. Here is your exact homework assignment to audit the active node infrastructure. First, open a high-level on-chain data platform. We're talking Glassnode, CryptoQuant, or look into Bitcoin. Second, pull up the daily active addresses metric for a major asset, say Bitcoin or Ethereum, and make sure you overlay it directly with the long-term price line. Third, zoom way out and start identifying those major historical cycle shifts. Now, here are the visual patterns you absolutely must lock into your brain if you want to rule the cycle. Notice how structural address drops, where users are literally abandoning the network, always precede massive bear markets. The smart money and the actual real users, they bail way before the price truly crashes.
Exactly. And on the flip side, address stabilization, where the user base finally stops shrinking and holds firm, that almost always signals a macro cycle floor.
Look, you've got to stop tracking sentiment via social media groups. The actual truth is written directly onto the ledger. So audit that active node infrastructure, apply Metcalfe's grid, and rule the cycle. I want to leave you with one provocative question today to really elevate your market strategy. When you evaluate an asset, are you just trading the speculative veneer, crossing your fingers that someone buys it for more than you did? Or are you auditing the active node infrastructure and mathematically verifying the network's true compounding value? Think deeply about that one. We'll see you tomorrow.